Everything I see, unemployment will be 16% instead of 10. Stocks will be down 86 S&P instead of 57. Everything's going to be about 50. Best way to look at this next downturn, if I'm right, it'll be 50% worse than 2008 to 9. And that is the worst downturn any of us have seen in our lifetime. The early 80s and the 73 to 75 downturn were not as strong as unemployment or stock crashes as that one. This is going to be stronger than that if I'm right. One of the things people miss when we had the last crash, okay, basically a lot of people exited, okay, and just didn't come back. People got to remember, the baby boomers are almost fully in retirement. They're in their retirement stage. They peaked way back, in 2007. So they've been moving increasingly into retirement and will continue into 2019. Into 2029 to do that before they're fully retired. But they are retiring. They are leaving the workforce and not coming back. So that's what people are missing. Oh, unemployment is remaining pretty low. It's because a lot of people have left, okay? They're not measuring those people. What happened to those people? And of course, they're going to be spending less money in retirement. People peak at 46, plateau into their mid to late 50s, and then spend less in the retirement and death. So the largest generation in history is just going to be spending less, and that is going to be a drag on the economy. And that is what would have, without all this stimulus, caused much higher unemployment and much weaker stock markets from 2008 through 2023 here. Now I say, because they pushed this off, we don't probably bottom in this downturn in stocks until mid 2024, maybe late 2024. So a couple of years later than the natural time, which would have been late 2022 in these cycles. And we have yet to see the deepest downturn yet. This downturn should be 50% stronger than the 2008 to 9 downturn, okay? And the stock market should be down 86% S&P instead of 57%. Everything I see, unemployment will be 16% instead of 10. Stocks will be down 86 S&P instead of 57. Everything's going to be about 50. Best way to look at this next downturn, if I'm right, it'll be 50% worse than 2008 to 9. And that is the worst downturn any of us have seen in our lifetime. The early 80s and the 73 to 75 downturn were not as strong as unemployment or stock crashes as that one. This is going to be stronger than that if I'm right. So if I'm right, you better get out of the way. And if I'm wrong, you might miss, a couple months of this thing before you realize I'm wrong. But I'm telling you, if I'm right, it's likely to follow through. We're well into this third wave down, and that's the damaging one. That's the dangerous one. I think you're going to see that hit in the next couple of months. So just give me 2 months of you being conservative and see if I'm right. Then you can listen to me and continue to follow me. But just be careful the next 2 months is my advice today. The economy, why can't this generation afford real estate? Because we had the greatest real estate bubble in history, a second one, which you never see, as I say, 2 bubbles in a row. We had a first real estate bubble in 2000 and then a second one now. Real estate is the most unaffordable it's ever been. And we didn't have a real estate unaffordability problem even in the roaring 20s bubble, okay? It was a stock bubble because real estate was too hard to finance back then. Back then, you know what a mortgage was? 50% down and 5-year termination, okay? 5-year maturity, okay? So people couldn't speculate and couldn't get loans so easy back then. So we've had very easy mortgages, a second real estate bubble. And that, of course, that's why this poor generation can't afford to buy a new house or the same house a baby boomer could have when they were in their late 20s. Typically, your first home purchase is peaks at 31, and then your second home, your trade-up home, your largest home peaks at 42. Well, for this generation, they're not getting their first home until 34 to 35, and who knows when they're going to get their trade-up home. And that's why the economy will solve this overnight, David. All we need is a big recession, which will look at more like a depression, and real estate will come down. And this is my forecast as well. Stocks 86%. Real estate will come down for the average house 50%. And people say, oh, that can't happen. We just saw 34% in the last downturn, which the central banks purposely cut off before it did its work, okay? That would have, so 50% is not a stretch. And this is what's gonna hurt most people. The stock market goes down, comes back faster. Real estate didn't bottom in the last downturn, 2008 crisis, until mid-2012, 6 years later. Stocks bottomed a couple of years later, okay? So real estate is what's going to hit people the hardest, and we probably will not, and I've been predicting this for a long time, not just recently, we will not see the peak real estate prices we've seen here for the rest of our lifetimes, if ever. Not even in the millennial boom, because the millennial boom will not be in a bubble era like the roaring 20s or like the 90s and 2000s here. They'll drive real estate back up, but it will not get to bubble levels because it will not be a bubble boom. What people have to realize, and my recent books have been bubble this, roaring 2000 stuff. We won't see this again. We will not see a bubble economy for our kids will probably not even see a bubble economy decades and decades from now. They are rare. The last bubble economy was the early 1900s into 1929. It happens once in a lifetime at most, every 80 to, bubble cycle is a 90-year cycle. The saving cycle is from the kind of early 50s into retirement, age 63, okay? So that's when people save. They're not even there yet. Yeah, they're saving a little bit, but this is going to clear them so they can actually, the millennials will actually be able to invest in financial assets, from real estate to stocks to bonds, at fair valuations again, so they can actually appreciate in the next boom, their boom, okay? The baby boomers are seeing a totally artificial bubble here that was way past their natural peak in 2007. We should have been in a downturn since then. And so this is an artifice, but this is gonna kill the baby boomers, because they're the ones in retirement now or about to enter retirement, the last third of them, and they are not going to have that as much savings as they thought. And they're gonna feel like, oh my gosh, I gotta keep working. I can't even afford to retire. This is gonna be the biggest crisis in the baby boomers' life. The biggest crisis of the Bob Hope generation was the Great Depression. This is going to be the big crisis. The final kind of depression into this is going to hit the baby boomers the hardest, because they're going to need that net worth that's going to disappear at the speed of light. And I mean disappear and not come back. First of all, the natural cycles will turn up around late 2024. So 2025 on would be bullish without stimulus, is what I'm saying, okay? That's when we will see the millennials actually, for good, solid reasons, driving up the economy again, okay? So now, that could start a little later by pushing this out. This crisis, this crash now, that only started at the beginning of 2022 with the peak in the S&P 500, is likely to last well into mid to late 2024, when it normally in the cycles would have been over by late 2020, early 2023. So if we have this crash, if this crash is allowed to continue and they don't blow their way out of this one, and you got to remember, they've been tightening now for a year, okay? And they're about to stop that, but not turn around and loosen again. So they're still in a tightening mode overall, okay? So if the economy keeps going down, then we could be over this as early as the summer of 2024 for the stock market. And I would say at the latest, late 2024. It depends on how it proceeds from here. But if this crash, if this third wave of the third wave I'm talking about continues down, and if it does, you should see that by about mid-June, give or take, okay? So it's not going to take long to see us down. Oh my gosh, now we're not talking 30-some%, we're talking 50-some% for the NASDAQ, okay? And close to that for the S&P. That's when people understand this is not a correction. This is not something that can be fixed by money printing. We are in a deep downturn. And then they get scared. And then it's hard to get them spending money again, because they're scared, and they should be scared. 2008-9 crash was 57% on the S&P 500. So yes, no, this is basically what that crash should have been. People didn't notice, it's pretty obvious. About a year and a half into that crash, the central banks just stepped in and just started printing money, unprecedented rates to blow us out of that. That's what basically happened. So that recession didn't really do its job of flushing out the greatest debt bubble in history, which I've been warning about for years and decades, bigger than the Roaring '20s, which ended up in a bubble in the stock markets, and the crash of a lifetime back then, now down 89%. For the Dow, which was the leading index back then. I'm predicting as much as 86% for the S&P 500 in this crash and 92% on the NASDAQ. So in that realm of something you only literally see once in a lifetime, if that. So this is nothing. This is what my point is. Most financial advisors are right most of the time. You can just sit through most corrections and rebalance and that sort of stuff, because it's not easy to time the market, as most people know. Okay, but this is so important that I am timing the market. I warned about this in my newsletter, off the charts. 2 huge warnings in mid and late December saying this crash is about to happen. It is going to be the crash of your lifetime. And next thing you know, we were down 38% in the NASDAQ in October of last year. And that's just the first wave down. There's 2 more to follow. And I think we're just about to see, or we've already started the next wave down, which could take the NASDAQ down to 8,000 just in this next wave, not the end of it. And that's going to be down a little over 50%. And that's when people are going to know this is not a big correction. It is a major crash, one that you have not seen in 73, 74, or 80, 82 in your lifetime, and one that even the millennials will not see a bigger crash than this when their boom and bust hits many decades from now. Never before, look at the Great Depression, look at any major downturn, the mid-70s, never before have central banks declared war, literal war on recessions, and said, we will not let the economy fall. Mario Draghi was the first one that said, he said to traders who were shorting the European markets back there in 2020, when we should have had the real crash started, okay? He said, I will print unlimited amounts of money. Do not bet against me, you damn traders. And that's what they've done. They have pushed this off. But even with all this unprecedented $9 trillion for the Fed alone in money printing, never have we seen even a fraction of that, okay? Even with all of that, we keep falling back in a recession. We just came out of the COVID downturn, and with all this massive stimulus, $10 trillion, half of it fiscal, half of it monetary, the biggest single 2-year stimulus in all of history, topping everything before that, and we're already falling in a recession again. That's the problem. The economy underneath is really, really weak and really needs to get rid of a lot of really bad debt and zombie companies, and the central banks won't let the economy do its thing. Oh, we're free market capitalists. No, we're not. If you trusted the free markets, you'd let the free markets do what they do, and central banks have declared war on the free markets. That's the problem. And the free markets, thank God, look like they're going to win this. I've been fretting to my subscribers saying, you know, I don't know if we'll ever have free markets again. I mean, this may never end. If the economy gets its way and we have this crash, it means the markets have taken back over. They're going to do what the economy really needs and not listen to stupid central bankers who never had to run a business. Find me one that meets either of those 2 definitions or looks like it. What are these people doing in charge in the first place? Okay, so that's what I see. The economy looks like, and that's why we're in a critical point right now. The economy is set by looking at the waves, and I've spent years and years studying what I call Elliott wave theory, brought by Robert Prechter. He's another good guy to interview, by the way. We're about to hit this third wave of the third wave, which is when the crash gets its most momentum. If that happens, if they can't stop this, and I don't think they're going to be able to stop it. I think it's going to creep up on them before they can reverse their tightening. That's what shows people, no, these guys do not have control of the economy. They're not able to stop this crash, and then they lose credibility.